HBR just achieved something no cryptocurrency has ever done before, becoming the first project to graduate from the Linux Foundation's elite program. But while champagne should be popping, the charts are painting a completely different story. We're talking about a brutal 53% liquidity collapse, whales dumping their bags, and a stablecoin market that just evaporated $70 million overnight. So, what the hell is happening with HEDERA? And more importantly, should you be buying this dip or running for the hills? Welcome back to the channel, Crypto Warriors. If you're tired of getting caught off guard by these market moves, make sure to smash that like button and hit subscribe with notifications on. Today's analysis could literally save your portfolio from disaster, or help you capitalize on what might be the opportunity of the year. HEDERA is having the most bipolar week in crypto history. On one hand, they just made institutional headlines by becoming the first project ever to graduate from the Linux Foundation's LF Decentralized Trust program. We're talking about validation from the same organization that backs Red Hat, IBM, and Accenture. This isn't some random tech blog giving them a participation trophy. This is the Mount Everest of open source credibility. But markets don't care about your achievements when fear takes over. While HEDERA is achieving technical milestones that should have institutions drooling, their DeFi ecosystem is getting absolutely demolished. According to DefiLlama's latest data, we're witnessing a liquidity apocalypse that's making even battle-hardened crypto veterans nervous. The timing couldn't be more ironic. Just as Canary Capital files for an HBAR ETF with a hefty 1.95% management fee, the underlying network is watching its stablecoin market collapse faster than a house of cards in a hurricane. It's like getting accepted to Harvard the same day your bank account gets emptied. Multiple sources are reporting that HEDERA's stablecoin market just suffered a catastrophic 53.39% drop in liquidity. That's not a correction. That's an extinction-level event. When over half your stablecoin liquidity vanishes overnight, it raises serious questions about the network's fundamental stability and investor confidence. The carnage is painted across every metric that matters. HBR itself is down 7.38% for the week, but that's just the surface damage. The real story is hiding in the on-chain data, and it's absolutely terrifying. The total value locked on HEDERA dropped 9.72% in a single day, with only $69 million in stablecoin liquidity remaining. Mostly USDC holding the fort while everything else burns. According to blockchain analytics, the bull-bear power indicator is flashing the worst reading since July 25, 2025. For context, that was during one of crypto's darkest periods this year. But here's where it gets really interesting and potentially terrifying. While retail investors are panic selling into this liquidity crisis, institutional players are making moves that could completely reshape HBAR's future. The question is, do they know something we don't? Or are they about to get burned alongside everyone else? According to Bloomberg's ETF analysts, there's a 90% probability that at least one HBAR ETF gets approved before year-end. But here's my take. Canary Capital's proposed 1.95% management fee is telling us something important about their confidence levels. For comparison, their Litecoin ETF proposal came with a 0.95% fee, exactly half of what they're charging for HBR exposure. Either they're being greedy, or they believe HBR's risk-reward profile justifies premium pricing. Given Canary's track record, I'm betting on the latter. Multiple sources are reporting that HBAR's support level at 21 cents is absolutely critical. This aligns perfectly with the lower Bollinger Band, creating a technical setup that could either trigger a massive bounce or signal complete capitulation. The fact that this level coincides with institutional accumulation zones makes it even more significant. The Project Hiero graduation isn't just a feel-good press release, it's a fundamental shift in how enterprise blockchain adoption happens. When the Linux Foundation puts their stamp of approval on a project, it opens doors that were previously locked shut. We're talking about enterprise clients who won't even consider blockchain solutions unless they have this level of institutional backing. But markets are forward-looking beasts, and right now they're focused on immediate pain rather than long-term potential. The 53% liquidity drop is creating, honestly, a perfect storm of forced selling and margin liquidations. When stablecoin liquidity evaporates this quickly, it creates a cascade effect where every seller struggles to find buyers. HBR is just getting hit harder because of its lower market cap and reduced trading volume. The whale behavior is particularly interesting here. According to on-chain analytics, large HBAR holders are reducing positions, but the selling pattern suggests strategic profit-taking rather than panic dumping. From a technical perspective, HBAR is approaching a make-or-break moment. The 21-cent support level isn't just a random number, it represents the 200-day moving average and the previous cycle low. If this level holds, we could see a violent bounce as short sellers get squeezed and bargain hunters step in. The ETF narrative adds another layer of complexity to this situation. While Canary Capital's 1.95% fee seems steep, it reflects the premium institutional investors are willing to pay for regulated crypto exposure. The fee structure is actually bullish for HBAR's long-term prospects, even if it doesn't help with immediate price action. Here's what most analysts are missing. HEDERA's ongoing swift testing for cross-border payments could be the real catalyst that matters. While everyone's obsessing over DeFi metrics and liquidity crunches, the traditional financial system is quietly evaluating HBAR for real-world utility. The September 29, 2025 update on Project Acacia's HashSphere implementation is another wildcard that could completely change market sentiment. According to multiple industry sources, this isn't just another pilot program, it's a full-scale deployment that could demonstrate HEDERA's enterprise capabilities at an unprecedented scale. My expert opinion, this liquidity crisis is creating an asymmetric risk-reward opportunity for strategic investors. Yes, the short-term pain is real and could get worse before it gets better. So the key here is really timing and position sizing, dollar-cost averaging into this weakness. It actually makes sense for long-term holders. But swing traders, well, they should definitely wait for confirmation that the 21-cent support holds. If that level breaks, we could see another 20 to 30% decline before finding the next major support zone. What's really fascinating is how this situation kind of mirrors those early Bitcoin and Ethereum adoption cycles. Institutional validation, it often comes during the most painful market conditions when retail sentiment is honestly at its worst. The smart money accumulates during these crisis periods, positioning for the next major uptrend when fear eventually turns to greed. The broader crypto market context also matters here. With Bitcoin struggling and altcoin sentiment sitting near cycle lows, any positive catalyst for HBAR could, trigger some really disproportionate upside. The ETF approval, enterprise adoption news, or even just a simple reversal in risk appetite could send HBAR significantly higher from these levels. Risk management is crucial in this environment. While the long-term thesis remains intact, short-term volatility could test even the strongest hands. Setting stop losses below key support levels and maintaining proper position sizing ensures you can survive the volatility to benefit from eventual recovery. The HBAR story is far from over, and this liquidity crisis might just be the setup for one of the year's biggest comeback stories. Whether you're holding, buying, or staying on the sidelines, make sure you're following the data rather than the emotions. If you found this analysis valuable, check out my deep dive video on institutional crypto adoption patterns. And don't forget to subscribe for more no-nonsense crypto analysis that cuts through the noise to find the signal. Disclaimer. Remember, this is not financial advice, just one analyst's perspective on a rapidly evolving situation. Cryptocurrency investments carry significant risk, and you should never invest more than you can afford to lose. Always do your own research and consider consulting with a financial advisor before making investment decisions.